Hey traders, this is Blake Morrow with Trader Summit, and I have Mr. Jim Welsh with Macro Tides here a day early as we're going to talk about the markets, especially ahead of the non-farm payroll number. We're hoping that you guys and gals are going to get this video ahead of the jobs number so we can talk about it. But Jim, I want to say welcome and thanks for being here.
Always good to join you, and it feels a little bit like an unnatural act doing it on a Thursday afternoon with about 45 minutes before the close, rather than our normal, Friday morning. So I'm ready.
It does feel a little odd. Now, I mean, the thing is we've got some really big, well, first of all, we got big numbers that are coming out tomorrow with the jobs report. We had, Fed Chairman Powell, he did his Humphrey Hawkins testimony. As you've been saying, he really didn't suggest he was going to do anything different. Now, I figured that would be the case anyway. With all the politicians, we're going to be hammering him. They're hearing from their constituents about, inflation and how, recession. And so, of course, they're going to be, pressing him hard. So he's got to give certain answers. But, the dollar just continued to rally. And, how did you feel about everything?
Well, my expectation was, as I wrote in the Monday Weekly Technical Review, that he wouldn't really basically say anything different than what he has been saying. And that is, we're in it to win it. We're going to maintain the funds rate at a high level for a long time. And it's important that we do this. The difference, as I noted on Monday, is that Wall Street now is actually listening to what he's saying, as opposed to, for most of last year, kind of ignoring it. Other than when he did the Jackson Hole speech. Whoa, that was a wake-up call. So there's been those moments, but on balance, February 2nd of this year, the Fed funds futures were looking for 487 as the high on the funds rate, and then dropping by 50 basis points by year end. And the Fed was saying, no, we're going to 5.1 and we're staying there. Now we've seen the table turn, Blake, in that the Fed funds futures are up above 560 with no rate cuts. So that they went from doubting Thomases to true believers at this point. And I think the markets are set up for less bad news. In other words, what really drove the 2-year from 4% over 5% over the last month was the strong employment report, stronger, inflation numbers. So it was the data that really got the market's attention, as opposed to whatever the Fed was saying. Now the data has confirmed what the Fed has been saying. People are bracing for, a number that causes the Fed to do more. There's now more and more talk about the Fed going to 6%. As you know, I don't think the Fed has clearly said that they want to avoid the mistakes of the 1970s. And back then, what they did is they kept jacking up the funds rate, tipping the economy in a recession, forcing them to then reverse course to offset the recession before inflation was fully squeezed out of the economy. They don't want to do that. So, they've said, well, we're finding our way toward the modestly restrictive level. That's why they did 25 basis points on February 1st. I'm still of the mind that they're going to do 25 at the March 22nd meeting, because if you go from 50 down to 25 back to 50, it sounds like you're just blowing with the wind.
Yeah.
Okay, so what I've said 2 weeks ago was there's going to be a trade, though. So those who only want to do 25 will say to those who want 50. And we know Mester, Bullard wanted 50 back at February 1st. Kashkari was probably in that camp as well. The trade-off is, all right, we'll take the dots from 5.1 up to 5.4, maybe 5.5. So we show everybody, we only went 25, but we're intent on raising the funds rate a little bit more. And I think that's the way they retain credibility. The point is, though, if I think there's a 76% probability as of today that the Fed funds futures are saying the Fed's going to go 50 basis points. So if the employment report comes in under 250 and hours worked drops a little bit, the average hourly earnings downticks from 4.4, pardon me, I think it's like, oh, wait, maybe the Fed won't have to do, keep hiking 50. And the CPI next week, again, it's a rate of change. You take 80 basis points off from February of last year. Even if you add 50 basis points, which would be a pretty stout monthly increase, the CPI is going to go from 6.4 to 6.1. So my point is, I think I've been looking for a flush job kind of leading up to this stuff, and that the markets would sell off in reaction to Powell. I thought the dollar would pop above 105.35, which was the high of last week. It got up to 105.88. So to me, things are falling into place. The data has to obviously come in as I just described. The dollar pulls back, and then risk assets rebound as a result of that change in perception that, oh, wait, maybe the Fed doesn't have to go 50 basis points. So I think there's a rally coming in the stock market. I think Treasury yields back, when was it? February, I can't remember. Last week sometime. Maybe it was March 2nd. I recommended TLT. I think yields have the potential of coming down more in anticipation of this softer data and the overreaction by Wall Street. So to me, things are unfolding pretty much as you and I have talked about over the last week and what I wrote about it in the weekly technical review.
That's right. Well, let's take a look really quick, Jim. And let's go look at what you've got here for your odds. And I'm sorry, I'm trying to find the right button. Here we go. There we go.
It's Thursday afternoon. It's not Friday morning.
It is. And I kind of got like I kind of lost all the buttons there for a second, but we're good to go. All right.
Yeah. So here it is.
What
this was yesterday.
Here? This is 65. Go ahead.
This is the odds of a 50 basis point hike at the March meeting. It was 65% yesterday. I just read it's up to 76% today. So it's like, oh my God, Wall Street, wait, didn't you see any of this coming? Again, no, they didn't. I just think this is an overreaction. The next chart shows the Fed funds curve. And remember, back in late January, I was showing this. And the Fed funds were talking about a peak at 487, then 2 cuts by the Fed before the year end. I said, that's not going to happen. Sooner or later, we're going to see the curve go up. Now we're up to 563. And as you can look at the bottom axis, you can see there's really no rate cut priced in for the rest of this year. So Wall Street all of a sudden is paying attention. It took the data to get their attention. If I'm right and the data softens a little bit over the next week or two, the market's going to react to that. Probably overreact to it.
Yeah, that's the market, right? You kind of get the swinging pendulum, if you will.
Yes. And the next chart kind of shows, I think it shows sentiment.
Oh, no, I have, I'm sorry, I had yields, but let me go ahead and grab
the call put ratio.
Call put ratio, yeah.
Okay, so the bottom part, you can see the bottom panel shows the 10-day moving average of the call put ratio. And I do calls divided by puts. I think everybody else does it put call, but Marty Zweig, back in the mid-'80s, the guy who developed this, did it call put, so I continue to do it the way he did it. As you can see, that green line is where you have as many calls as puts. And back in late September, leading into that low in October, and then, of course, at year end, at the end of December, we're almost as low as we were then. Yesterday, there was 115 puts for every 100 calls. So, and 4 out of the last 6 days, more puts than calls. So people are really on their heels, Blake. And I just says, to me, this sentence suggests that unless we have a complete wipeout, we're close to potentially seeing the market poised for a rebound as the data comes in. And if I'm right, the rebound can be pretty sharp. The S&P potentially could trade up towards 4250. Again, I've been saying I think we're going to get a rally above 4195. If the data comes in supportive, it could test that trend line up near 4250.
It's always hard to say that when you have a day like as we're actually filming right now. Equities are down quite aggressively. Yes. But hey, if that's what your counts are showing, that's what we're looking at. So
the other thing too, that red line on that S&P chart is the 200-day average. So last week we got a bounce off the 3940. I thought that bounce was kind of that potentially we would see that taken out. And that would create even more pessimism. So potentially we're going to get a flush here going into the close on Thursday that takes the S&P below that 3928. But again, if the data comes in and catches people off balance, we're going to see a pretty good snapback rally. And I still think the odds favor that.
All right. Well, you had the TLT chart here. And so what's this going to do for bonds?
Okay, well, again, if, as we've talked, I thought we would see a rally in bond prices. Treasury yields would come down from the high in early December. I thought TLT completed an ABC getting below that late December low at 99 something or whatever it was.
Yeah.
And March 2nd, it did. And I sent out a special update saying, hey, buy it under 99.35. I think we're going higher. And TLT can get up towards 102 to 104, depending on a 50% retracement of the decline that we saw from the high in December. So again, you need data. You need that 50 basis point hike at March 22nd meeting to get taken off the table and to get the juice, to make that happen. If Treasury yields come down, I also sent you a chart of the QQQs, and they've been very, very sensitive, high PE ratio stocks to Treasury yields. And this was from an hour and a half or so ago, and obviously things have softened since then. But the top panel shows the relative strength of the Qs to the S&P, and what we can see is as the market peaked on February 1st and everything declined, the Qs held up much better than the S&P. So if you're looking for a rally, you want to go with whatever it was that held up prior during a sell-off for that next rally. The bottom panel shows how overbought, oversold it is. We're near where we were in late December.
Yeah.
If I'm right about all this stuff, the potential is that the Qs could get a pretty snappy rally up to that green trend line at 325. Now, as you know, the bigger picture, I've been bearish. I think we're getting a rally, and then ultimately, I think the S&P is going to drop to 3,500. I think there's a recession coming, or at least a very significant slowdown as we get closer to mid-year. So this is, again, just catching Wall Street being offside. For a long time, they didn't think the Fed was going to follow through. Now they almost believe too much. And if the data comes in and says, oh, wait a second, maybe the Fed won't go 50 basis points, that would provide the juice for a fairly significant pop in a short period of time. Ultimately, does it change anything that the Fed's going to do? No. The Fed is going to continue to creep the funds rate up. More importantly, hold it at that high level. And I think over time, we'll see the economy slow down and head towards a recession. And that means lower earnings. The PE ratios get compacted. So all I'm doing is just trying to catch a very short-term move based on what I think is Wall Street's kind of over hawkishness at this time.
All right. Well, it's going to be really interesting, and I think it's all going to start with tomorrow, actually.
Absolutely.
But yeah, let's take a look at the dollar. How are you viewing the dollar right now? Because the dollar has been I think people are a little hesitant ahead of the jobs, even though stocks are coming off. The dollars really hasn't responded, but they're waiting for the jobs report tomorrow, right?
Yeah. I thought, as I said last week when we talked, I thought there'd be another push above 105.35, and that would be it for the beginning rally here. So to me, it looks like 1, 2, 3, 4, 5. We got that on that pop yesterday on the 2-year going above 5% and so forth. That to me completes 5 waves. We should see a pullback below 103, maybe 102.50. We'll see. Again, if the dollar has rallied as the 2-year went from 2% in the first couple of days of February to over 5%, if that comes off the boil a little bit because, hey, the Fed may not have to go 50 basis points, I'm assuming that means the dollar is going to pull back.
Okay. All right. Well, that's fair. But just so everybody knows, it can still go the other way, right? I mean, we can still
always.
All right.
Always.
All right.
Again, I'm looking at it, Blake, as like 517,000 jobs. Some of that was definitely due to seasonal adjustments and so forth.
Yep.
Very, very warm weather. So that messes with the seasonal adjustments. And I just think there's a good chance. If you go back the last 18 months, job growth had a trend like this. And then you'd get 1 month that would go above that line, then it come back down. That trend line would suggest under 250, closer to 200. You get any kind of a number like that, I think that maybe the Fed doesn't have to go 50 basis points. So we'll see. If I'm wrong, you're right. The dollar will go the other way.
Well, let's. What do you see with the dollar or gold? Excuse me, because gold can probably give us a clue here.
Yeah. Again, I'm looking for gold to pop. If the dollar backs off, gold, the dollar bottom February 1st. As you know, I sent out a special report timed to buy the dollar. It was trading just around 101.
Yeah.
On February 24th, a special report, time to get out. It was a 105.20. That was back on February 2nd is when gold topped, and it made the low a few days after in February. I'm looking at that as that first bounce is an A, the pullback is a B. I think the gold is going to rally above 1859 at a minimum, and then 1870 to 90 is just, looking at a 50 to 618 retracement of the decline from 1958 down to 1806. So I'm just looking again. Dollar pulls back. All the things that have been kind of, facing a headwind because of dollar strength, are going to get a breather, and then we'll go from there.
Well, it'll be really interesting because the dollar, it seems it's going to be very pivotal in this entire move. But I think it's really still the data as well. I mean, we've learned from the Fed, and from comments from the Fed Chairman Powell. I mean, we are very data dependent, especially with this jobs report and inflation data coming in this next week. So,
it's interesting, Blake. On Tuesday, he basically said the same speech on Tuesday and Wednesday.
Yeah, and
he said, if the data comes in stronger, we're ready to accelerate the pace of increases. Tuesday, oh my God, Then yesterday, he said if, and I said if. In other words, trying to say, folks, you're overreacting to the word if. The data hasn't shown up yet. And as you know, the next 5 months, 4.6 points are going to come off the CPI. Because you take away last year's February to June. If it averages a 0.4 increase in the next 5 months, that means you're going to subtract 2.6 points off of the 6.4. So the CPI is coming down hard. In the next 5 months. Again, the focus for the Fed is going to be on the labor market. Yeah. So, again, Wall Street hasn't paid attention to that aspect, I think, to the level that they should be. But, we'll cross that bridge in the next few months.
Well, Jim, I want to thank you for taking us through all this ahead of the jobs report tomorrow. It's going to be such a critical report. Remember, we have CPI and PPI next week. And I know Jim's really good about sending his updates as they come through, or as things change to his database. So how do I jump on your mailing list and be a part of Macro Tides?
Macrotides.com, or send me an email, Jim Welsh Macro, and I'm happy to send out a recent report, give you a better idea of how I combine fundamental, technical, and monetary analysis into a beautiful picture.
Well, thank you so much, Jim. We appreciate your time. As always, if you like what Jim has to say, make sure you give him a thumbs up. If you have things that you want to mention in regards to things that he did say, comment down below and subscribe.
I respond to those comments, Blake.
Yeah, keep responding to them, and I'm sure people love it. I know I would love it. I try to do it best I can as well. So make sure you're jumping in there. Thanks, Jim, for joining us. We'll see you next week.
Have a great weekend, one and all.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.